Welcome back to the Bitcoin podcast. Today we are joined by Dr. Josh Hendrickson, professor and chair of the Department of Economics at the University of Mississippi, Ole Miss. Josh is one of a small number, at least in my view, of academic economists in the country who've made Bitcoin a serious research subject, not as an advocate, but as a monetary economist asking hard questions about what money is, why government monopolies on currency exist, and whether Bitcoin changes the answers. His published work include papers on the political economy of Bitcoin, the economics of banning cryptocurrency, and what Bitcoin's value looks like 100 years from now. He's a senior fellow at the Bitcoin Policy Institute, the American Institute for Economic Research, and he co-writes the popular economics newsletter, Economic Forces. Josh, welcome to the show.
Great to be here.
So you've written that Bitcoin solves a problem first described by economist Benjamin Klein in 1974, the commitment problem of competitive money. Can you explain that for us and why Bitcoin might be a solution to that issue?
Yeah, so Ben Klein was asking this kind of purely academic question, I think, but nonetheless an important question, which was, so he was writing in the 70s. The United States had sort of closed the gold window. A lot was up in the air about what the monetary system was going to look like going forward. And at the time, a lot of people were either writing as though we would bring back some version of gold convertibility, or as though we were just moving to this purely fiat system where, central banks would just have a monopoly over currency issuance and that sort of thing. And Klein kind of started out with this thought experiment, which was, well, what if we could have competitive money? But what if we could have competitive money without having to bring back gold convertibility, right? So the basic idea is that bringing back gold convertibility would probably be too big of a political constraint. And so, but could you have competitive fiat type money, right? Could you just have banks issuing their own banknotes? And on some level, when you present this idea to people, they think, well, of course not. Of course you couldn't do that. It's not redeemable for anything. Why would anybody accept it? And how could you trust these people? And Klein actually goes through this really, really interesting kind of thought experiment by just saying, well, it's not that there would be no constraint, right? If you are, if you're a large bank, you have a reputation. And so your reputation matters. And so if you actually care about that reputation, you would limit banknote issuance because you would try to maintain your own reputation. You would try to maintain the reputation because the better the better your reputation is, the more banknotes you could have out there in circulation, and the more banknotes you have out there in circulation, the bigger your balance sheet is, the bigger the profits that you can potentially earn. And so that, it's not obvious, right? That all that would need to be the case is there would need to be some kind of property rights associated with your specific banknotes, right? So that counterfeiting laws would have to be applied to all the different brands of currencies and things like that were issued. And so as long as that kind of stuff was protected, he kind of said, well, there's no reason to think that you couldn't have something like this. But then there's the question of, okay, what would it take to be sustainable? Because one of the points that becomes obvious is your reputation matters sort of in day-to-day operations. Your reputation is a constraint, but you could always cash out your reputation, right? So one thing that you could do is you could spend years crafting this reputation, making your bank larger and larger, getting your banknote circulation really, really high. And then one day, without telling anybody, you could just print up a bunch of banknotes, go out, buy a bunch of things with those banknotes. And then once everybody realized it, the value of your banknotes would collapse, the bank would go under. But in the meantime, you would have transferred all of this wealth to yourself. And so his point is that you could trust the bank to be honest if the expected, if the present discounted value of future profits was greater than that one-time transfer. But of course, we don't ever know whether that's true or not, right? So as a technical matter, yeah, you can say, well, of course, as long as it's more profitable to just be honest, then people will be honest, and they won't pursue this other strategy. But you're not privy to that information, and so this leads to this sort of Klein problem, right? Which is that, well, yeah, you could have a form of money that's not really redeemable for any other good, okay, and it could survive, but you would have to trust the issuer never to just pull that one-time transfer. And so most people kind of were dismissive of the paper as a practical paper, right? It was an interesting thought exercise. It got published in a really good journal, and people thought it was like an interesting academic kind of argument. But then you fast forward to the introduction of Bitcoin, and now all of a sudden you see that, well, this kind of becomes applicable, right? And it becomes applicable because you've got this money that's introduced. It's brand new. It doesn't have any sort of, when it's created, it doesn't have any sort of, I hate this phrase, but there's no better way to put it. There's no intrinsic value, right? There's not something, it's not being used for any other purpose. It's just proposed as a new kind of money, right? And so if it doesn't work out as money, its value is zero, right? But if it does work out as money, then, it has positive value. Well, the question is, how would it have positive value? Well, if you apply Klein's framework, now you can see this, because one of the things that Klein suggested is that one way that banks could, could operate, right, in order to gain trust and prevent you from thinking that they're going to just walk away with this one-time transfers, they could impose limitations on themselves. They could say, we're only going to increase banknotes by this percentage a year, or we're not going to ever increase banknotes once we reach this point, or something like that. But of course, again, you have to trust them all the same. The thing with Bitcoin was that Bitcoin came along, it created this money that's very similar to the sort of money that Klein is talking about in his paper. But at the same time, it solved Klein's problem because it has a fixed supply, and the fixed supply is written into the code, and everybody can read the code, everybody can see the code, and so you don't actually have to trust anyone, right? And then not only that, the incentive structure is such that there's no reason to change the code, right? So like one of the common criticisms was, okay, yeah, that's in the code, but somebody could change it. Well, because of Bitcoin's decentralized design, everybody gets to choose what version of Bitcoin they want to run. And so no one who is running like a current version of Bitcoin would ever upgrade the software to a version that just has like twice as many Bitcoin, because that would dilute all of the value of the Bitcoin they already own. And so not only is it built into the code, but it creates an incentive structure where nobody actually has the incentive to change the code, because nobody can benefit. You can't secretly create a bunch of Bitcoin without anybody noticing, like you could in Klein's example with banknotes. And for me, that was kind of that was kind of like the early lesson of Bitcoin to me, is like when I first heard about it, I was thinking about it in the context of all of these different sort of, when I heard about it, I had just kind of finished my dissertation, and what I had really been interested in was sort of like alternative monetary institutions. So I was very familiar with these kinds of works like Klein and things like that. And so for me, I saw parallels to some of these alternative monetary institutions into Bitcoin. And then I just thought, this could be a really interesting thing to study.
Yeah, and the history of banknotes, free market money. I've done case studies of John Deere, the man, not a little bit of the company as well, but you go back to 1830s, 40s, 50s, United States. And it was a pretty fragmented system, but people still figured it out. Kale and I have done some work. So in Iowa at the beginning of in the Great Depression, when banks had failed, there was a town that created a script that worked. And Irving Fisher, of all people, traveled from Chicago to Iowa to learn about this thing. So there is an interesting history of, those things coming out. And then you put technology, Bitcoin behind it. It's like, oh, yeah, cap supply. Could be transparent with where it is.
Josh, you talk about decentralization and what happens during upgrades. How are we protected against the incentives of bad responsibility? we just got asked this by some farmers today, and we get asked it all the time. Well, what's the reason to run a node? And we always cite that as the reason. I like to say, can you imagine central banks giving you a vote in what happens to their monetary policy? Well, that's kind of what happens, when you're running a node with Bitcoin.
Yeah, I think one of the things actually that really solidified Bitcoin's decentralization was that was like the block size war, for example, right? So there's this huge debate about, what do we do, you know, about block size. So back in, I mean, I guess this really started in about 2016 and then into 2017, but you had people who were essentially arguing that, hey, this thing isn't going to scale, and it's not going to scale because it's not going to process enough transactions in a certain amount of time. But if we, increase the block size, we can, then we can process lots more transactions, and that will, that'll allow it to scale. And the counter argument to that was it will undermine decentralization, because if you double the block size, well, then what's going to happen is that over time, the memory that it takes to store all of those transactions is going to get larger and larger, and so it will make it much harder for individuals to actually run a node without having to constantly update their hardware or whatever, and so what played out was an actual case study of sort of how this works, right? You had a lot of powerful people, who were in and around Bitcoin, who were advocating for the bigger block size. And what that really taught everybody is that Bitcoin changes by consensus, right? Is no individual or no group, no matter how big their sort of economic power is around Bitcoin, has the ability to change it. What matters is sort of and even to this day, you hear this, like people will say, oh, well, who matters more, like the miners or the node runners or, casual users, all these things. And the answer is that everybody matters. Like, that's the point. It's not just, it's not just one group, or another group. It's not about, hash rate. It's not about economic power. It's not about whether you're Coinbase or whether you're like a big publicly traded miner or something like that. Is that, it operates on consensus, and it operates on consensus not only because people have can voluntarily, upgrade or not to the latest version of the software, but also it operates on consensus because those big players are actually subject to what they think the other people are going to do, right? Like, they want to know, well, if this causes a chain split, which chain is the one that's going to be considered Bitcoin, because that's the one that my customers are going to want, or that's the one that I'm going to want to be mining on, or et cetera, et cetera. And so that's the big advantage, is that it operates on, on the consensus of the network. And the consensus of the network is not some fixed percentage, but it tends to be like an overwhelming majority of the network, right? It's that the people kind of converge. They hear out, different proposals. They think about these sorts of things. That's what the block size war kind of taught us. And then they kind of start taking sides. And then you see this. And then also you saw during the block size war, you also saw that, you started getting futures markets for different versions of Bitcoin, so you could actually put your money where your mouth is when you say that, oh, I think this one's going to be better than this one, or something like that. And so that gave people an opportunity to not only signal which one they thought was going to win, but also to profit from those predictions.
Interesting. Kevin, could you do the question after this? But real quick, I'm interested. We did a podcast with Jack Watt, who was also in the Satoshi Papers with you, and he talked about mostly fiduciary media and the prospect of Bitcoin bills. So you talked about network uh network transaction scale, right? Do you see technical upgrades like Lightning as being the way, or fiduciary media like Bitcoin bills, or a mix of both, maybe?
So I don't tend to worry about like the scaling problem, because markets are really good at solving scaling problems. And I think that, one thing that people don't, one thing that people, especially who are new to Bitcoin or who just want to think about Bitcoin by itself, they'll just look at it and they'll say, well, of course you can't have, of course this can't be like a global payment system, like, because how are you going to process like, look at how many payments are processed across the world every day, or just look at how many transactions that like Visa processes a day or something like that. And now let's like back that into the Bitcoin ecosystem. But the thing you have to understand is that you're comparing apples to oranges here. Like, what Bitcoin is providing is final settlement. Visa doesn't provide final settlement. Like, they're processing these transactions, but they're not providing final settlement to the transaction. And so it's easy to imagine, scenarios where people are exchanging Bitcoin without ever touching the base layer of the network, right? I mean, Lightning is a prime example. If you're if you're using Lightning, the only time that you're interacting with Bitcoin and making on-chain transactions is when you're opening and closing channels, right? Right. And so you can run a Lightning node and you can transfer, payments via Lightning, and you can do that without touching Bitcoin. Well, those are still Bitcoin transactions. And so I think that ultimately, I mean, the market will figure out like how they want to decide. I mean, it's controversial now, but I don't find, I don't find a lot of the debates about that to be ultimately worthwhile at this current moment, because a lot of times what people are saying when they're having those debates right now is sort of like, well, my preference would be X and you're suggesting Y. And that's the thing, is that sort of how the system evolves is going to depend on, what sort of the market chooses. And sometimes the market is aligned with your preferences and sometimes it's not, but markets are good at solving scaling problems. And so I think, so I'm pretty confident that over time, there'll be, several different possible solutions to, and probably given the way that Bitcoin operates, like you might not have to make choices, like you might have to in the current system. There might be multiple options, right? So the people who don't want to accept sort of claims, to Bitcoin that can't be, one-to-one verified or something like that, they'll have that option. Whereas people who are willing to just use, something that's equivalent to a banknote redeemable for Bitcoin, they might do that as well. Like, I think that there'll just be a variety of ways to deal with that kind of issue.
Josh, how do you think that, sort of looking forward, if you could parlay that into kind of where we've come from? You've written about things going back as far as like Scottish free banking and stuff like that. And in our own country, right, we had sort of free banking period as well, period of gold standard, a period of not quite a gold standard, and then now for the last 50 years, kind of fiat. And like you say, markets to scale. And it's hard to imagine all the alternatives. It'll be based upon preferences and what succeeds and what works and what doesn't.
Yeah, I think that probably the biggest thing, I actually think that this is hardest for possibly like Americans to understand, is these alternative systems, because first of all, the American consumer benefits from our current system quite a bit. And so, and for the most part, I mean, anybody, who is, listening to this is probably, has probably never lived in a world, where we weren't under the current system. And so, at least, and if they were old enough to remember that current system, they probably, aren't old enough to have a lot of, sophisticated views on what that system was like. Right. And so for the vast majority of people, the current system is kind of like all that we've ever known. And then the other problem for Americans is that U.S. monetary and financial history is a mess. Like, the United States is kind of notorious for having a bunch of banking crises and a bunch of debates over banks and central banks and branch banking and all these kinds of things that we rarely even think about today. But a lot of that is peculiar to the United States. And so the problem is there's been a lot of stuff that's been written on sort of how terrible, markets are at dealing with money, at dealing with banking, and why, you need like a huge role of government in these things. But if you actually look, if you actually compare, um, these, if you actually do comparisons across countries and across time periods, you find that that's just not true, right? The Scottish free banking period was a time of remarkable stability, and you had banks just issuing their own notes redeemable for gold. These were private banks. Um, in the United States, our sort of free banking period was kind of chaotic. But that's sort of like because we left it up to the states, and the states all got to decide, and different states had different rules. And so some states, this operated really, really well. And in other states, it operated somewhat poorly. But yeah, and I think that, well, and the other thing too is that people are taught fairy tales about the old system, right? Like the gold standard was a time of remarkable stability and economic growth. If we think about, what's considered the classical gold standard period from about 1870 until World War I, this was a period of remarkable peace, prosperity, the purchasing power of your currency, whether that was the dollar or the pound, it was roughly equivalent in 1913 as it was to what it was in 1870. Those are remarkable accomplishments. Now, there are, of course, flaws with the gold standard in the sense that, there's flaws with anything, right? Like there's no perfect system. And I think one of the things that we mistake oftentimes is that, in our modern system, it's easy to, I always go back to this line. There's a monetary economist, Jörg Nihans, and he wrote a book in 1979 on monetary theory. And he has a chapter in the book on commodity money. And he kind of starts off by saying, you might be wondering why I have a chapter on commodity money because, nobody's using it anymore. But writing in 1979, he says, well, maybe that's true now, but I don't know how long that will be the case, because what's rare is the system we have now. Commodity money has actually been around forever, right? Commodity money is the system that passed the market test. And so, I think it's worthwhile, for people to understand how it works. And in sort of his conclusion to that chapter, he points out that, look, in the current system, it's possible to design the system such that it provides all of the benefits of the gold standard without any of the costs. And he says, but that's a theoretical outcome. And so the question is not whether this current system can outperform the gold standard in theory. The question is whether it can outperform it in practice. And he essentially just concludes the chapter by saying, well, time will tell whether it can actually, improve on it in practice. And I think that's the huge lesson, is that so much of this is a frustration I have in general, is like so much of our conversations about money and the financial system and these kinds of things, it's a very sort of Whiggish history, right? It's this sort of like we're always just progressing to the next best system, and like things are always just we're always solving old problems with the new system that makes it better, and then we discover a new problem, and then we move on to a new system that makes that old system better. And that's kind of the way that we tell that story. And I'm sorry, but the evidence for that is just not true. And in fact, like, a lot of the policy decisions and a lot of the direction of our monetary system and our financial system is actually tied to the desires of the state and what the state wants. And it's not necessarily, sometimes they're operating to try to improve the system, and sometimes they're operating to try to make the system a little bit more useful to them. Right. And so the kind of story that we tell of sort of, well, we had all these bank failures, and then we got the Fed, right? And then we had the Fed, and then, the Fed made some mistakes, but then we did, but then we did this. And It's always told in a way that we're always sort of learning from all these previous mistakes, and things are always progressing to a better and better outcome. But when you actually dig into the data, that's just not true. If you compare the years under the Fed to the years prior to the Fed, it's not clear that the Fed has improved economic performance at all.
So yesterday was Father's Day, and so a little bit of reflections. I've been around for a while, let's say. Anyway, my first working memory is my dad, when I was 5 years old, had me working afternoons helping with our irrigation. We had gravity irrigation in south central Nebraska where I grew up, so there's just a lot of back and forth. And so he bought a three-wheeler that I could drive as a 5-year-old, and my pay at the end of the day is that he would stop by a gas station to fuel up the three-wheeler and the pickup truck, but I would get a 10-ounce bottle of Coca-Cola and a bag of beer nuts. And so just for the heck of it, I went to ChatGPT and said, what might have that cost in 1972? And so its best guess was that the bottle of Coke cost 15 cents, and the beer nuts, was probably better data, was 10 cents. So I worked for a quarter for the afternoon, but then I stumbled across, and I'd heard this before, but Coca-Cola had famously been 5 cents a bottle from 1886, when they went commercial for the first time, until 1959. And then they just couldn't take it anymore. And I'm surprised they could even stick with it that long after the inflation of post-World War II. But they had petitioned the Treasury in 1953 to create a 7.5-cent coin so that the vending machines would still work, because that's how they sold. You put in one nickel. Well, they wanted 7.5. Anyway, Treasury refused.
Well, this is the example that people give, all the time, is that if you go back to around the time that we closed the gold window, there were people who were working for, I think the minimum wage was close to like $1.25 an hour. Well, if you go back to that time period, right? Well, actually, if you go back to when we had quarters that were made out of silver, like $1.25 an hour was an ounce of silver, right? And so, if you think about wages being paid out in terms of ounces of silver, if you were paid an ounce of silver today, that'd be a pretty good wage, right? And I think that much higher than what the minimum wage is today, given the current price of silver, much higher than probably the average wage today. So that's kind of indicative of the kind of thing that you're not told about, right? Because, you're told all the time that, well, the Federal Reserve, promotes price stability. Well, it doesn't promote price stability. What it really promotes is inflation stability, and they're not even particularly good at that, right? So when I think of price stability, I think that, okay, what something costs me today, that should be what it costs me 10 years from now, right? In dollar terms. And that's not at all what you have. What you have is, prices go up by 2% on average a year. And lately they've been going up by a lot more than 2% on average a year. And so when you think about it that way, it's not really at all like it was in, the pre-fiat currency days, right? Like they're not doing the same sorts of things. They've redefined terms, right? Like they not only have control of the money supply, they have control over what price stability means. The English language has become part of their control.
Okay. So your recent paper introduced the idea that we've shifted from the Federal Reserve standard to a Treasury standard, where government debt itself functions as the base money. What does that mean for the average person? And how does Bitcoin fit into that picture in your mind? And what does it imply for dollar stable coins like USDC?
Yeah, so I think that kind of like the big change when we left the Bretton Woods system. So under the Bretton Woods system, this is what we had after World War II. The dollar was redeemable for gold. $35 would get you an ounce of gold. But it was only redeemable by, foreign governments and foreign central banks. And but then everybody else just, had fixed exchange rate. Everybody else in the system had a fixed exchange rate with the dollar. So they would just define their money as some particular amount of dollars. And since dollars were defined as a particular amount of gold, then, they were indirectly, worth a particular amount of gold. The problem is, of course, is the United States created way too many dollars for the system to continue. But when that system finally collapsed with the closing of the gold window, there was a question about what the new system would be, right? Because if now all of a sudden gold is, if people could take dollars and redeem them for gold, and then all of a sudden they have these foreign central banks have all these dollars and it's no longer redeemable for gold. Well, how does this work? And what are they going to hold in reserve? Because they're not just going to hold pallets of cash in vaults somewhere, right? What are they going to do? Well, the United States had actually started kind of pushing towards the current system, not deliberately, but definitely on purpose. Well, and what I mean by that is like, I don't mean to suggest that the United States had some vision about moving away from Bretton Woods and creating a new system, and that the new system would look like our current system. What it was is that the pressures of the Bretton Woods system were getting them to try to get foreign central banks and governments to adjust their behavior. So what they started doing is things like, hey, I know you have a bunch of dollars, you want to redeem them for gold. Instead of redeeming them for gold, why don't you just buy U.S. government debt? Why don't you just buy Treasury bonds? Because if you buy T-bills or you buy Treasury bonds, the bond market trades every day. You can always effectively redeem those for dollars if you need them, just like, you could redeem dollars for gold. But the thing about treasuries that gold doesn't provide is that treasuries pay interest. And so why would you want to have this yellow metal sitting in there that earns no interest when you could have U.S. government debt that pays interest? And so they kind of use their power in the world, their military power and their diplomatic power throughout the world to kind of strong arm a lot of people into doing those things. And in fairness to the United States, I mean, what they were arguing is that at the time, people were, and it sounds quaint now, but at the time, people were worried about how much money the United States government was spending. And the United States was essentially saying, look, part of the reason that we're spending so much money is, we're helping to rebuild Germany. We're helping to rebuild Japan. We have military bases all throughout the world because, most of your militaries were decimated in the war. And so now, we're providing you with national defense. We're spending all of this money in your country. And that money's got to come from somewhere. And so, we're basically providing you with a public good. And you're providing us with nothing but complaints that you can't redeem these dollars for gold, right? That was the United States' government position. And so what happened is, they used, their diplomatic power to pressure people. They started telling the Japanese and the West Germans and others, you should just have a line item in your budget that requires you to buy U.S. government bonds because, we're providing these military bases, you should pay for them. So we have to spend money to maintain this military base and to pay these soldiers and to, get equipment over there and all this kind of stuff. Well, we're doing that for you. If it wasn't for you, we wouldn't be doing that. And so that requires us to spend X number of dollars. So why don't you just buy X number of dollars worth of government bonds? And then it's as though you're actually paying for it. And wouldn't that, help solve the problem? And so they started doing things like that. Finally, when they closed the gold window, that became the official policy of the United States, was to get all of these countries to just use treasury securities instead of gold as their main reserve asset. And they were remarkably successful. Sometimes they did this through sort of clandestine, agreements like they had with Saudi Arabia, where they went to Saudi Arabia and said, we want you to price your oil in dollars. We want you to use those dollars to buy U.S. treasuries. And in exchange, we will put you under our defense umbrella and we will provide you with weapons and things that you need for your own defense. And so the Saudis agreed to do this in secret because they were afraid that their Middle Eastern allies would not like them buying U.S. government debt because the United States provides aid to Israel and things like that. And so this was done in a very clandestine way. And like, it wasn't officially acknowledged, I don't think, until about 15 or 20 years ago. And so, but they went through all these diplomatic things. And so again, that's the point of like, this pushes back on that Whiggish history, right? We didn't get here because this is just like the new next best system. We got here because there was a lot of diplomatic arm twisting, and there was a lot of, we're the, swinging a big stick, right? Like that was we have the biggest military in the world. You don't want to be on our bad side kind of, diplomacy. But so we ended up in this system. Why does this matter? Okay. The reason that it matters is, the system itself that we have means that the United States dollar is the global reserve currency. So what that means is that if you look at trade is predominantly done in dollars around the world, regardless of whether the people are trading with the United States or not. They are trading in dollars. So you'll have two countries, neither of whom actually use dollars, who are using dollars to buy each other's goods, right? But then the other aspect of this is then you have the U.S. Treasury security as a global reserve asset. And so what that means is that this has kind of replaced gold as the main sort of central bank asset that foreign central banks hold. Why that matters is, well, maybe we could talk about why that matters to the public versus why that matters to the government. Let's start with the government. The government likes the system. Why does the government like the system? Well, the U.S. being the global reserve currency means that the dollar is much stronger than it could ever be otherwise. It has a premium that it wouldn't have if it wasn't the global reserve currency. That means that all else equal, it sort of makes the United States wealthier than it would be otherwise because everything else is cheaper, abroad. The other issue here is that by having the U.S. Treasury securities as a global reserve asset, what that means is that you have this massive passive demand for U.S. government debt. So in other words, most of the time when people are deciding, do I want to buy German bonds? Do I want to buy Greek bonds? Do I want to buy, Japanese bonds? What you're thinking about is, am I going to get paid back? What is the risk reward? Like, what is the interest rate that they're paying compared to what I think the risk is that I get my money back, in terms of its current purchasing power. And, but for the United States, you have a bunch of buyers who don't care about that at all. They just have to take these dollars and recycle them into, treasuries, which means you get passive buyers. Passive buyers means that the buyers in your market aren't all that interest rate sensitive. And so what that means is that the United States tends to be able to borrow at lower rates than it otherwise would be able to. And so the United States can accumulate more debt than it otherwise would be able to. But it also creates this perverse system, right? And the perverse system is that this system works really, really well when the United States is growing faster than the rest of the world. So when the United States is growing faster than the rest of the world, what that means is that our economy is growing faster than like the demand for our debt is growing. But if you look at the recent decades, global growth outside the United States has been growing faster than in the United States, which means that reserves, like a 1% increase in your GDP tends to lead to a 1% increase in like reserves, right? Like unitary elasticity for money, as economists like to say. But what that means is if they're growing faster than you, what that means is that their demand for more and more of these debt securities to hold as reserves are growing faster than your economy. So you are now stuck in a difficult spot. One thing that you could do is you could just ignore that, conduct fiscal policy completely independent of borrowing costs, conduct fiscal policy completely independent of like the demand for your debt. And in which case, have a pretty prudent fiscal policy, in which case you're not supplying enough debt to the market. So there's going to be a premium on those bonds, which means that's going to drive yields really, really low. The problem, if you do that, is that sounds great, right? Because we look at that and we go, wow, low interest rates for Americans. That's amazing. Like, think about how cheap it will be to buy a house. Think about how cheap it will be to acquire assets. Like, I can borrow money really cheaply, buy assets. I can just become wealthier. This is great. The problem is that also just leads to really, really bad business decisions, right? When you have really low interest rates, virtually anything appears profitable. But whether it's profitable or not is going to depend on what happens to interest rates subsequent to that, right? So if you borrow at 1% and something is profitable and then all of a sudden interest rates rise to 4 or 5%, it's suddenly not profitable anymore. And so now you've misallocated all of these resources towards, towards, uses that you never should have done and that you never would have done without that, without that distortion. But suppose that you supply the debt that people want to the market. What that's going to mean is that if you're just supplying whatever debt that people want, then the magnitude of your debt is kind of demand determined. And this creates, what we call nonlinearities, right? And nonlinearities are sort of like the worst kind of things in economics, right? Everything that we think of that, sometimes they're good, but every bad thing is really kind of like a nonlinearity, right? And so what I mean by that is like a nonlinearity for like a practical purpose is like the turkey that lives on a farm, right? The turkey that lives on a farm every day, the farmer comes by, the turkey gets fed, and the turkey's like, man, this farmer is the greatest guy in the entire world. I just come out here every day. There he is. He just feeding me, takes care of me. He's so great. And then like Thanksgiving happens, right? That's a nonlinearity. And so when you look at this system, it creates this built-in nonlinearity, which is that nobody really cares what the borrowing cost of the United States is. Nobody really cares what the interest rate is on the debt because they're using this as a reserve asset. The problem is that encourages you, like, you're never going to live in that world of low interest rates for long because politicians see that they can borrow basically for free. And what are they going to want to do? They're going to want to spend money, which means they're going to want to borrow even more. Why shouldn't we do this? Like we're borrowing at, 1%, and so they accumulate a bunch of debt. Well, when you start to accumulate that debt, what happens is that, yes, there's this passive demand for debt, but there comes one day when all of a sudden people look around and they go, whoa, look at how much debt that there is. I don't think I'm ever going to get paid back, right? Like, I don't ever think that I'm going to get my dollars back. And even if I do get those dollars back, the purchasing power of those dollars is not what I expected them to be when I did this. So if that happens, that you get that nonlinear effect where all of a sudden there's kind of a run on the dollar, right? And people just kind of, and it becomes a self-fulfilling prophecy. People don't think that you can pay the debt back, so they all start selling the debt. And then who's going to buy the debt? Well, the Federal Reserve will come in and say, oh, we're going to stabilize the Treasury market, right? And then they buy the debt to stabilize the Treasury market, where over time what this is they're just is that all of that debt is moving from foreign central banks to our central bank. And to do that, they have to create more money. And so that's going to lead to inflation. And so you get the self-fulfilling prophecy where you end up inflating away all of the debt. So why does this matter to the United States? It matters to the United States because the United States government gets a bunch of benefits from this, being able to borrow cheaper than they otherwise would. That's great for them. Like, being able to use this as a tool of foreign policy is great to them. Like they, not only is everybody using the dollar, but then they can actually use sanctions, right? And so if they use sanctions, everybody's using dollars, which means that everything at some point is crossing these dollar payment rails. Those dollar payment rails are subject to the legal jurisdiction of the United States. So the United States can go to its enemies like they've done in the past with Iran, like they've done in the past with Russia, and they can say, oh, you know what? You're cut off. Like you're not allowed to make these payments anymore. You're not allowed to use these systems. And not only that, we'll have secondary sanctions. So if somebody tries to help you by facilitating payments for you through our system, then we'll punish them too, right? And so there's a lot of benefits to the United States government of the system. Now, there's a lot of benefits that have come to the United States consumer also. So people living in the United States, this has been beneficial to them because the strength of the dollar has meant that everything around the world is much cheaper than it otherwise would have been, which means that consumers have been able to consume more in real terms than they ever would have been able to consume without this system. The other thing is that in those periods where interest rates have been low, consumers have benefited. People who locked in, 30-year mortgages at 2% interest, they're laughing all the way to the bank every month when they make their payment. And so, there have been benefits to the U.S. consumer. The problem, though, is that there those benefits are starting to come with a cost, and they're starting to come with a cost because we're starting to see the costs of having out of control U.S. government debt. We're starting to see also we've seen this over the last 20 or so years, which is that the same strength of the dollar that has allowed consumers to consume more than they ever have has also given the incentive for people to move production from the United States into other countries, because it's already cheaper. It's already cheaper to go hire somebody to make shirts in Vietnam than it is in South Carolina. But now, if you can pay the person in Vietnam in their local currency, and then you can earn your revenue in dollars, well, now it's not just that labor is cheaper. It's that now you're making an arbitrage profit on top of that cheaper labor from the strength of the dollar. And what that's done is it's hollowed out a lot of our manufacturing base. It's hollowed out a lot of our production capacity in the United States. And it's led to a lot of, it's led to a lot of economic costs that are geographically dispersed. And so for a long time, these were kind of like, well, that's a local problem, or that's a local problem, right? And then now over time, those local problems have become regional problems and have turned into national problems. And so the system itself largely serves the interest of the United States government. And for a long time, the United States consumer was getting the benefits of that. But now what you're starting to see is that, consumers are also workers, and workers are starting to get the short end of the deal. And so it's not clear that this is working out. It's certainly not. There are certainly some people where it's definitely not working out, but other people where it was working out for them, it might not be working out for them anymore. And so we're starting to kind of see the stress on the system. Okay. So how does that relate to Bitcoin was your the second part of your
That
question.
was the second part, yeah.
Yes. The way that it relates to Bitcoin is that the United States has taken a very different attitude towards both gold and Bitcoin in the last couple of years. Okay. They've said very positive things about both. I think that there's a deliberate reason for that. If you are the United States government, you kind of see that this system might not be sustainable long term. So if you're the United States government, though, you want to maintain the system as long as possible. Okay. But if it's not going to be sustainable long term, the one thing that you want to make sure of is you want to make sure that there's not some other sovereign country who is going to take over this role. You don't want them to switch from the dollar to some other currency, right? You don't want them to switch from the dollar to, say, the yuan or something like that if you're the United States. Because what you would be doing is you would be transferring all of the benefits of the system over to, potentially an adversary. So I think the reason that they've been promoting things like gold and Bitcoin is because Bitcoin and gold are neutral assets, right? There's not a single entity, there's not a single country that produces Bitcoin or gold or these kinds of things. So because of that, when you think about Bitcoin, the reason I think they've taken a positive attitude on Bitcoin is that if they could convince people that this is a better reserve asset, hey, you don't want to hold a bunch of treasury bonds, why don't you consider holding gold? Why don't you consider holding Bitcoin? That's going to reduce the benefits of the current system that we're getting, okay? But it's also going to relieve some of those costs, and it's not going to transfer the benefits that the United States government currently gets to some adversary government somewhere else in the world.
Yeah, it certainly seems like the current administration at least is trying to thread this needle. Yeah, it's a tough one, but it's like reshore manufacturing. Make Bitcoin a central reserve asset. Have a legal framework for stable coins so that there's still treasury purchase. For every dollar stable coin that Circle or Tether has, there's a treasury behind it. And so, yeah. And anyway, how do you think about that on a go-forward basis? Is it a needle that can be threaded?
Well, I think that's actually a deliberate strategy if you think about stablecoins, because when you look around the world at central banks, the treasury securities as a percentage of their reserves have been falling now since I think about 2014. And what they've been replaced with is gold. So central banks around the world are holding, fewer U.S. Treasury securities and more gold as a percentage of their balance sheet. The stablecoin stuff seems to me to say, okay, well, if central banks aren't going to hold as much of our debt, we still have a debt problem. We still have somebody who needs to buy this debt. And so stablecoins are a way of accessing sort of consumers rather than central banks around the world. Anybody with a smartphone can download, an app, and they can buy stablecoins, from whatever local exchange that exists, or they can use a VPN or something to get to access them via an exchange, and then they can store them in a wallet on their phone, and then they can actually trade in dollars and without any real oversight. And so what this does is it provides access to dollars to consumers around the world who have never had such access before. But now all they need is access to a smartphone, and now they have access to dollars. The reason that's important is that all of this stablecoin legislation has made it so that, the only assets that you can have on your balance sheet are you can hold those dollars that in reserve at the Federal Reserve, or you can buy U.S. Treasury bills, right? And so you can see that it's kind of like, well, if the foreign central banks aren't going to hold Treasury bills, maybe what we can do is we can have U.S.-based institutions issue stablecoins, and people around the world want access to dollars, right? The average consumer would rather use the dollar than whatever their local currency is in many, many countries around the world. So let's give them access to those dollars. And then the more dollars that exist as stablecoins, they're going to, means the more demand for T-bills. And so maybe you can replace some of the demand from central banks with demand indirectly from, consumers around the world.
Stable coins, like they eat weaker currencies, which is really interesting. It's like,
no, absolutely. I mean, in some sense, you can argue, look, you can take a very cynical view and say, look, they're just doing this because they want to finance the debt, and they want to finance the debt cheaply, and they want to do whatever they can to sort of prolong the system. But there is a sort of benefit to these consumers, is that if they're able to get access to these things, that's going to put a constraint on their local central bank. And and in fairness, we probably have too many currencies to begin with. Like, there are certain countries where you can't even exchange your currency, in foreign exchange markets. If that's the case, what is the, what's the real justification for having a currency, right? It's very, it's used in a very sort of localized circumstance, but beyond that, it's not particularly useful. And so maybe in places like that, they should be replacing their local currency with dollars anyway, or something, that's actually easy to exchange, or easy to use, or has more stable value. There's an obvious reason why these countries have those currencies, is because they have control, right? And so removing that control might actually be, really good for these consumers, because it'll put constraints on their local monetary authority.
Well, you talked about the stress of this dollar that's artificially high, and that kind of gutting manufacturing. There's some export industries. Another export industry that we think a lot about at Bitcoin is agriculture. And so the best consumer for U.S. agricultural products has always been the U.S., but export markets typically for most grains, most all agricultural commodities, importance of that 10% of production that goes to export markets is just significant. And between an overvalued dollar, trade wars, and everything else, at least at the moment, like, agriculture is not good. And I realize you don't probably spend a lot of time thinking about agriculture, and that's about all that we spend our time. But we thought, why don't we wrap up our conversation today just asking you for what perspective you might have on agriculture, into an industry that sells into globally competitive markets, and we producers, farmers, face and have faced for a long time kind of this classic cost price squeeze where, you've got to scale to try to bring your costs down, but your input prices go up pretty much every year.
Yeah, you're in this tough spot because sort of as part of this system, you know, the United States government over time has also tried to use its diplomatic power and also its sort of power over international institutions like the IMF, the World Bank, the World Trade Organization, things like that. The United States has tried to use its power oftentimes to kind of guarantee to kind of guarantee markets, right, foreign markets for U.S. agriculture. And in some cases, arguably, right, at great expense to some of these foreign countries. The IMF in particular, we think of the IMF as being this sort of detached from, it's this international institution. No, the United States has complete veto power over everything that it does. So it's effectively, it's effectively controlled by the United States. But the United States uses a lot of these levers to kind of help support agriculture. But the problem is when it comes to agriculture is kind of like, it's sort of you're sort of taking from with your left hand and giving with your right hand, right? So you're creating the system where you make the products uncompetitive because the dollar is so strong that that's making U.S. agriculture less competitive. But then on the other hand, you're trying to sort of correct for that by sort of using this diplomatic power to maintain these resources. But I think what that really speaks to is kind of the difficulty of sustaining the system, right? Like I feel like this system that we're in, it's like when you go to a carnival and you're playing whack-a-mole, right? Like, like there's a problem that pops up and you hit that problem and you're like, I solved that problem. And now here's another problem, right? And you're just constantly doing all of this. And so what you end up with is you end up with a bunch of piecemeal policies where you're trying to correct for all of these distortions that are created by the system. And it's not clear to me that you can actually sustain that long term, right? Like it's clearly you can have short run victories, but the problem is you're just constantly going to be hitting the next mole, right? You're constantly going to, there's constantly going to be these unintended consequences, and there's constantly going to be these things that you have to adapt to just because of the way that the system operates in the first place.
Real quick, I want to get in there. Kind of adjacent to the whole stablecoin flywheel strategy. I share your idea on that, by the way. But is the strategic U.S. Bitcoin reserve? I saw in the past you may have been critical of how we'll be able to use this administration, future administrations, and whether or not it will be somewhat tied to the Federal Reserve. My idea was that we have a pro-Bitcoin Fed chair now in Warsh. Trump supposedly wanted to have him run the economy hot. Maybe he could run the economy hot and clean it up on the back end using something like a U.S. Bitcoin reserve. What are your thoughts, and why were you critical before, if that's right?
Well, I don't know that I mean, I guess I was critical in the sense that I was just not cheerleading it. I don't think I was necessarily all that critical. So, I do think that, I don't know if this will happen, but it's entirely unclear to me what the Warsh strategy is, because Warsh is constantly saying things like, we need lower interest rates, while simultaneously saying things like, well, we need a smaller balance sheet. Well, I hate to break it to you, but if you sell off a bunch of assets on the Fed's balance sheet, it's going to make it much harder for you to get interest rates down. So I'm kind of confused on that. Now, one potential strategy to get yourself out of this, I don't think that we're there yet, so I don't think this is the strategy, but one potential strategy is, you've got too much debt. So what you do is just run the economy hot, have 6 or 7% inflation for 3 or 4 years. And then you look up and all of a sudden, the real value of that debt isn't so bad anymore. Now, of course, this is incredibly costly to you and I. This is incredibly costly to U.S. consumers. This is incredibly costly to society in general. It would completely undermine the faith in the dollar system. So you would be throwing away the sort of privileges that you have. But at a certain point, that strategy might also just be, the least bad option among lots of bad options. I don't think that we're there yet. So I don't necessarily know that that's the case. I think that if there's going to be a strategic Bitcoin reserve, I don't think it's going to come through the Fed at all. I think it will be done through the Treasury. The United States, okay, so the case for doing this is that um, the United States owns lots of assets, right? So the idea, like, so a lot of people scoffed at this, like, oh, why would the United States own that? Well, I mean, you could look through like Treasury reports and explain to me why, look through, I mean, just go through any big federal government agency, and you're going to find that they own assets that you had no idea that they own, right? And so you could ask the same question about that. Why do we own this? Why do we own that? I think if it was going to be done, I think it would probably be done through the Treasury. I think that it would just be, they would sell it as, hey, we're just buying this. It's one asset among many assets that we own. The advantage of doing it is that buying some and having it on your balance sheet gives you the option to sell it at some point in the future, right? So you would have to demonstrate a commitment that you're actually willing to hold on to it. If you buy it and then, a new administration comes in and sells it right away, like, well, then that's out the window. But but I think kind of what you would be buying it for is the option value. Okay. So what you would be doing is saying, okay, we're going to buy this now because we think that this could actually be, an important global currency at some point in the future. And if it's an important global currency at some point in the future, then it's probably worth, 10 to 20 times what it's worth right now. And so, wouldn't it be nice to just buy it now? And then, 50 years from now, 100 years from now, the dollar value of that would be much, much higher. And so if we were still on this, if we were still struggling with debt, you could start selling off some of that Bitcoin to pay off, to kind of pay off some of that debt and things like that. Like, I think that would be the main mechanism. But I think also they might also be buying it for signaling purposes, right? So they might also be buying it for signaling purposes in the sense that, look, they're trying to encourage people to use this more. And so what better way to encourage them to use it more than to kind of give it the U.S. government's, good housekeeping seal of approval, right? And so, like, if the United States government is going to hold it, well, then, other people around the world might go, oh, hey, maybe we should do that too, right? And so it might be for signaling purposes. Now, where I've been critical is, like, you can't really say, hey, we're going to buy this because we think at some point it's going to be worth a lot more, and then we're going to sell it to pay down our debt, because then you're just creating the expectation that at some point you're going to sell it, which kind of undermines the case for having it on your balance sheet in the first place. The other thing is that you have to be careful about how you do this, right? So the magnitude of your purchase is actually important here, right? Like, if you just buy a ridiculous amount of Bitcoin, that might freak the market out, right? So if you buy a bunch of Bitcoin saying, oh yeah, we'd like to have this on our balance sheet, because currently our debt's unsustainable and we think this is an appreciating asset or something, just like gold or which is also on our balance sheet, or land, which is also on our balance sheet. Then, you got to be careful about the magnitude, because if you buy a whole bunch, like, all at once, then you might spook the market and they might think, wait, like, how bad are things there? Like, what are, like, how bad are things really? And then that could actually spook the market and then undermine, the system, because again, you create this self-fulfilling kind of prophecy. I mean, I think that's the difficult thing about when you study models of fiat money. There are always two equilibria, right? There's multiple equilibria in every fiat money model. There's two. There's one where the fiat money has positive value, and there's one where it has zero value. Well, the path from the positive value to the zero value is what we call hyperinflation. So and so you don't want to, and the thing about those models, right, is that small shocks in the model, if you're in the positive value equilibrium, small shocks don't matter that much. You kind of make your way back to that equilibrium, but big shocks can actually push you in the other direction, right? And so you don't want to be the source of the big shock. And so I think that you'd have to be careful about it. I mean, I think my main criticism has been that, and look, and in fairness, this might not be a valid criticism given that the government might not want to be explicit about what they're doing. But my main criticism has been, like, they've said they're going to do this, but they haven't really explained why they're going to do it or what their intention is. And maybe that's the point. Maybe they don't want to, because maybe they just want to let people speculate as to why they're doing it, so that, they don't have as much clarity about it. But I think that, in general, I think it's a possibility. I think that it's likely to happen on some scale. I just don't know, what scale it will be done at and when they want to do it. I do think if you look at the current administration, whether you agree or disagree with what they're doing, I think that if you look at everything that they've done so far and you kind of work your way through it in chronological terms, you will see that there's an order of operations to things where they clearly did one thing before the other, knowing that the other was probably coming. And so I think that, so I think they have been very, very deliberate about that. Now, they haven't always been, uh, clear about about that, but in certain cases you can't be clear, right? So I mean, like, if you think about it in foreign policy terms, you can't like announce that you're just going to go get Nicolas Maduro in the middle of the night, right? But I mean, I think that, if you look at kind of the order of operations of things, I think that there is a plan in place. And the trouble for the rest of us is that we don't really know what that plan is. And it makes it hard, because when you live in a republic, the people kind of get to decide on some level, but you're delegating your power to these other people. But then the way that you evaluate those people is, through them communicating what they're going to do and them doing things. And if they're doing more doing and less communicating, then, that it leads to confusion and, potentially, volatile election cycles, I guess.
Sometimes, Josh, economists or economics is described as the dismal science. So why don't we end today? And let me ask you, what makes you optimistic about Bitcoin and about the issues that you spend your time thinking about and writing about and studying?
Well, okay. I mean, first of all, to me, Bitcoin has been like a really just interesting thing for me to study. Like when I found out about it in 2011. And so to me, as a person who had just graduated, from graduate school, and was like getting ready to start a job, and who was a monetary economist, this was just exciting to me because I really never expected it to go anywhere, because it's so hard to get a network effect going. And so yeah. And so I never, I mean, I thought that, like, what we're seeing today, I thought that was a possibility. I just thought it was an extremely low probability event that we would end up, sort of where we are today. But kind of my feeling on it was, no matter what happens, it will be interesting to observe and to study, because it's an out of sample observation, right? Like, all of the monetary theory that's ever been written down has been informed by previous monetary history. And so you don't get many instances where you have these monetary models that are being used to think about some new type of money that didn't exist when the model was written down. So to me, that was exciting, and it's still exciting to this day, because every little turn in this in Bitcoin is kind of fascinating to watch. I mean, what gives me optimism is like, around Bitcoin is, I mean, I think everybody seems to have like their own kind of view about Bitcoin, and like what it should be and what the purpose of it is, and like whether people should use it, whether they should not use it, all that kind of stuff. And I think that back in the early days, like the early memes were really, really important for generating that network effect. But one of those kind of memes was this idea that, like, Bitcoin is, period, right? Bitcoin is, period, right? Like that's it. Like, it exists. Like, that was the important thing. And I think for a lot of people around the world, that is actually what's important, and what makes you optimistic is that if you have this type of money that's not controlled by some central bank somewhere, that just kind of exists, and in a decentralized form, that no entity has control over, this creates constraints on the monetary authorities, no matter where you are. And those constraints are important and valuable, and they're, and on net, are going to be good for um, human beings all around the world, right? Like their ability to be able to opt out wherever they are in the world of the current system, to have an alternative way of saving, to have an alternative way of transacting with people. Like that's really, really important, especially in the world that we live in today, where money is all, issued by by central banks and controlled by those central banks. And so, in the United States, I've spent the last half hour explaining all the problems with the United States' current system. But I mean, but the thing is as bad as it is in the United States, is much worse almost everywhere else. And so I think that even setting aside what's going on in the United States, even if you think that, hey, the United States is going to, you know, um, get through this and figure it out, and like we'll just keep going along. People throughout the rest of the world, this is a huge benefit to them, because they have access to a way of saving and transacting that didn't exist before, and that no government authority or central bank can manipulate.
Potentially a situation where you have governments at all levels that may have to present a value proposition to be able to gather up revenue. Imagine that. That's a much more optimistic world from my perspective. Well, Josh, thank you for taking the time. Thank you for your work. Anything else you'd like to leave with our audience, or any place where you would urge our audience to follow your work or keep in touch with what you're up to?
I mean, my academic stuff is all on my website, which I'm easy to Google. I'm on Twitter. I'm just annoying on Twitter and funny. I try to be funny. I don't know that I'm funny. You should never say that you're funny. I try to just have fun. That's not serious at all. I used to be serious on there, and then I just learned that that's not a place for serious discourse. Um, and then also, I don't know. I also, I rarely write about Bitcoin, but I have this Substack with a friend of mine, where we basically try to take economic concepts and boil everything down to essentially like supply and demand. And like that's what we're trying to do. And we started out writing it. So it's called Economic Forces. It's on Substack. We started out writing it for our students and like our friends' students in the profession. Like, here are things that you could give your students to read. It's not going to take them very long to read it, but it will kind of go over like a concept. And like sometimes we apply it to things that are going on in the real world. Sometimes it's just completely about that concept. We never thought it would be as popular as it is, but I mean, I think we have something like 25,000 subscribers or something like
Good
that.
for
So
you.
people really like this stuff, and we just try to take all kinds of complicated stuff and make it as simple as possible for two purposes. Number one, to sort of show people that you don't need to be a math genius to understand economics and to apply the concepts, but also that it is. But also that you can take these simple tools, and if you really master these tools, it's really a great way to interpret what's going on in the world, and to understand the world around you, and to be able to think critically about it, and also to see through, some of the claims that, politicians make and things like that. And so we don't really ever get into specific political issues or policies. I mean, occasionally we might touch on something like that, but we try to keep it more general for that purpose. Like, we're trying to get it so that you understand that economics is just a useful tool for the real world.
Great. Well, thank you for being with us.
No
Thank
problem.
you,
Thanks for
Josh.
having me.